For this session, we will talk about your not-for-profit organizations. So, in this particular topic, we will learn how to account for a not-for-profit organizations. In accounting for not-for-profit organizations or your NPOs, our main consideration is the fund provided to the NPO and how will we account for that fund. Normally, NPOs have different accounting of that fund, and we account for it depending on the type of donation or the grant. Now, this fund is the equity of the NPO. We should learn how to present that equity of the NPO and how to account for that. Later, we will also talk about the different types of NPO and their revenue sources. So we will account their revenue sources, and we also need to determine the difference between a not-for-profit organization and your government entity and your commercial enterprise. So before, under your GUM, what we look into as a difference is the difference of your commercial enterprise and your government organization. Now we look if there is a difference between an NPO, government, and your commercial enterprise. Okay, let's start your not-for-profit organizations or your NPOs by defining what is an NPO. So what is an NPO? An NPO is one that carries out some socially desirable needs of the community or its members and whose activities are not directed towards making profit. So that's why the term is not for profit organization. It's because it is not for profit. So if we try to compare now government, NPO, and commercial enterprise, a government is not for profit. A government is not for profit. An NPO is also not for profit, while a commercial enterprise is for profit. Therefore, as to the purpose of that particular organization, government and NPOs are the same, while NPOs and commercial enterprises are not the same, including your government. Uh, Next, as to the accounting, for the accounting of your government, it is accounted using your GUM and your PPSAS, while your NPO accounts for it using your SFAS 117, and this was already amended by your ASU 16-14, while your commercial enterprise is accounted using PFRSS. Actually, your NPO is accounted using SFAS or ASU together with your PFRSS. So ultimately, they have differences as to the accounting. Government uses fund accounting, NPO uses fund accounting, while commercial enterprise does not use fund accounting. Okay, so as to the usage of fund accounting, we already know what is a fund accounting. So in government, it uses fund accounting, NPO uses fund accounting, while commercial enterprise does not use fund accounting. For government, equity comes from appropriations, while in your NPO, equity comes from your grants or donations, while your commercial enterprise equity comes from your investments. Okay, so those are differences between the three items. So government, NPO, and commercial enterprise. So as to as to purpose, not for profit, and for profit, government, NPO, and commercial enterprise respectively. As to the accounting use or the standard use, in your government accounting, GAM or PPSAS, in your NPO, SFAS 117, as amended by your ASU 1614 and PFRS. In your commercial enterprise, it is purely PFRS. And for your use of fund accounting. GAM NPO uses fund accounting. Commercial enterprise does not use fund accounting. As to equity, equity comes from your appropriations, particularly for the government. For NPO, from your grants or donations. And as to your commercial enterprise, purely an investment from the owners. Now, our NPO, if you ask what particular law in the Philippines govern your NPOs, actually, we don't have a separate law for your NPOs. We don't have a separate law for your NPOs. Before anything else, please take note that your NPOs can either be a governmental NPO or non-governmental NPO. If that governmental NPO or that not-for-profit organization is uh, used by the government or is under the government, it should be accounted using your GAM. If it's non-governmental, then we use your SFAS 117 or ASU 1614 together with your PFRSS. So take note, not all NPOs are privately owned or privately operated. Some are publicly operated or operated by the government. So if ever it is operated by the government, account for it using GAM. If not, then account for it using what we will discuss later. Now, as I'm telling you a while back, your NPOs are not really a codified law. When I say not a codified law, there is no specific law that that is used in your NPOs. What we use is your revised corporation code. So if you remember in your revised corporation code under your special corporations, we have your non-stock corporations. And your non-stock corporations are under your section 87. I think section 87 of the revised corporation code. And in section 87 of your revised corporation code, non-stock corporations may be formed for normally charitable, educational, cultural, scientific, religious, etc., etc. So those are your non-stock corporations. So it is defined as a non-stock corporation under your revised corporation code. Now, under the tax code or the National Internal Revenue Code, or as amended by your Train and Create, your not-for-profit organizations is known as your non-stock, non-profit corporations or organizations, also known as non-governmental organizations. If you still remember, they are still used for religious, charitable, scientific, etc., cultural, etc. And they are normally not-for-profit organizations are organized and operated for that particular purpose, and they have certain tax incentives, whether that is a property tax or an income tax incentive. Furthermore, we have a separate law, RA 10693, which dwells with your microfinance NGOs. So microfinance NGOs is a non-governmental organization particularly used or created for microfinancing. So when we say microfinancing, it is giving of credit or savings. Microfinancing, that is giving of credit or savings, but ultimately for micro enterprises or those with low income, micro enterprises or with those low income. So the target of this law is to provide credit or savings to your low income individuals or low income enterprises. So microfinance NGOs has also a tax incentive as to its revenues and business taxes. So those are the different NGOs, non-governmental organizations, or not-for-profit organizations scattered towards our law. So we have in your revised corporation code, in the creation of a non-stock corporation, and then the taxation, we call it non-stock non-profit corporations or non-governmental organizations. RA 10693, which creates or solidifies and giving incentives to your microfinance NGOs. So microfinance NGOs, they are operating exclusively for microfinancing, that is credit or lending, including savings for micro or low income individuals. Now, let's go to your characteristics of NPO. So what are the characteristics of NPO? First, you receive contributions of significant amounts of resources from resource providers who do not expect commensurate or proportionate pecuniary return. So unlike your commercial enterprises, what happens is that there is an investor and the investor must have returns. While in your NPO, we do not call them investors. In NPO, we call them your donors or your contributors. And your donors or contributors will not expect any returns. But the donation or contribution normally is used in the furtherance of the purpose of the NPO. So, for example, the NPO is used for scientific purposes. Normally, the donations or contributions is used for the operations of that scientific purpose. Next, NPO operates for purposes other than to provide goods or services at a profit. So you already know that in your commercial enterprise, as it is for profit, while for NPO, it is not for profit. And when we talk about not for profit, there are different operations of your NPO that is not for profit. As we said a while back, it can be for charitable, scientific, social welfare, religious, literary, educational, whatsoever, so long as it is not for profit. Just remember, if it's for profit, then commercial enterprise; not for profit, then account for it using your NPO. Lastly, it does not possess ownership interests like those of business enterprises. So there is no ownership interest in the equity. Remember, it is more of donation or contribution. So those within that particular NPO only make use of those funds for the purpose of the NPO, and those within that NPO does not own the NPO itself. Those within the NPO are entrusted of that particular fund. Remember the concept in your government, if they are given a fund or appropriation, they are entrusted of that fund or appropriation for the purposes of that government. The same fund accounting or fund theory under your NPO. Those within that organization or NPO are only entrusted of that fund, which will be used in furtherance of the purpose of the NPO. So no ownership interest. However, in ownership interests, you already know that the ownership of your government organizations are owned by the people, while in your NPO, it's not directly owned by anyone. But it is for everyone. The purpose is for everyone, depending on what particular purpose is that for an NPO. So remember these characteristics of NPO. It is for contributions, and the contributions is used for the purposes of the NPO, not for profit, and there is no ownership of the NPO. Categories of NPO. So when we talk about categories of NPO, these are the different NPOs or the normal categories or types of NPO. So NPOs are normally created for voluntary health and welfare organizations. So if that is health and welfare, scientific, charitable, social welfare, rehabilitation. So those are types of VHWO. So VHWO, voluntary health and welfare. Voluntary health and welfare. So their main purpose is health and welfare. Another category is your healthcare organizations. In your healthcare organizations, these are your different hospitals. These are different hospitals. And then we also have your NPOs of your colleges and universities. Take note, when we talk about colleges and universities that are NPOs, they are colleges and universities considered as non-stock and non-profit. Okay? They are governed by your board of trustees normally. And then those NPOs that does not fall on any of the three categories are considered other NPOs. Again, I will keep on saying this. When we talk about your NPOs, you need to determine whether that NPO is governmental or non-governmental. If it is governmental NPO, it should be accounted using your GAM and your PP SAS. If non-governmental, then we account whatever we learn today using SFAS 117 or using your ASU 2016-14 or ASU 16-14. Remember that. Now, what is the standard used in accounting for NPOs? So as we said a while back, if the NPO is governed by your government, we use your GAM or your government accounting manual together with your PPSAS. While if that is a non-governmental NPO, we look whether it is accounting for the net assets. Net assets is also known as your equity. So if you account for equity, we use SFAS 117. In the presentation of assets and liabilities, we use PFRSS. Actually, there is a problem with this SFAS 117 and the new standard, which is ASU 2016-14. So your SFAS 117 together with your ASU, they are actually a standard provided by other standard setting bodies. Why? Because we don't have a particular standard used here in the Philippines in accounting for your non-governmental organizations or your NPOs. So we use your standards from other standard setting bodies. So your SFAS and your ASU, your SFAS and your ASU actually are given by your FASB, SFAS and ASU. So these two now is used in governing your not-for-profit. If you still remember, FASB is your Financial Accounting Standard Boards or Standard Board. So your Financial Accounting Standard Board issues this SFAS and ASU, particularly in accounting for your net assets. So when we talk about SFAS, this is the old standard. We call it a Statement of Financial Accounting Standard. And then we now have your ASU. We call this your Accounting Standard Update. So what's the relationship of SFAS 117 with ASU 16-14? In your SFAS 117, this is the old standard in accounting for your not-for-profit organization. However, it was updated using ASU 16-14, which is your accounting standard update 16-14 in the presentation of your net asset. So most books is still most authors or most books still use SFAS 117, wherein we account for three types of net asset. So it is your unrestricted, restricted, permanently restricted, and temporarily restricted. So that is your SFAS 117. However, in your accounting standard update, what happened is there is a problem as to this restriction. So that restriction, normally, some preparers of FS, of NPOs, are kind of mistaken in accounting for your net assets. So they think that when we talk about your restriction, it is the restriction of your contributions, either restriction provided by the donor itself or the entity or board of trustees. But actually, whether SFAS 117 or whether SAU 16-14, in restriction, this restriction must be donor imposed. It must be donor imposed always. Therefore, since the problem arises, the accounting standard update of FASB updated the classification of your net assets. Now, in your ASU, it is now classified as either unrestricted, it is either unrestricted or without donor restriction, or with donor restriction. So again, this standard is not yet, I think, used by the Philippines, or most of textbooks does not update it. They still make use of SFAS 117. But although they have the same thought, as long as the restriction is imposed by your donor. Take note of that. When we talk about restriction, it must be always donor imposed. It is donor imposed. It must not be imposed by the board of trustees. It is always donor imposed. And when we account for your assets and liabilities, we account for it using your PFRSS. So whatever is the uh, provision of your PFRSS, as you have learned before in your financial accounting, it still applies here as to the accounting of your liabilities and your equity. Take note, for this particular discussion, we will talk about unrestricted, permanently restricted, and temporarily restricted. Actually, still the same with your ASU, because in your ASU, when we talk about with donor restriction, that can either be permanent or temporary. So still the same, just that the categories are known differently. Okay? SFAS 117 as updated by ASU 16-14. Now we go to your FS of NPOs. So what are the FS of your NPOs? We have four. So unlike your other FS, in your commercial enterprises and your government entity, here we only have four. First is statement of financial position. So your statement of financial position, of course, has your assets, your liability, and your net assets. Now, your net assets, as I told you a while back, will be classified as either unrestricted, temporarily restricted, or permanently restricted. Now, we also have your statement of activities. Your statement of activities is like your income statement. It is like your income statement. So it has your revenues and your expenses. So the revenue of your NPOs come from your contributions, or your donation. And your expenses can either be a program expense or a support expense. So when we say program expense, these are expenses to fulfill the purpose of the NPO. And if that is a support, these are other expenses not classified as program expenses. Take note, program, any expenses in furtherance of the purpose of the NPO. Furthermore, take note, expenses of NPO decreases unrestricted net asset. Expenses of NPO decreases unrestricted net assets. If you try to look at it, expenses should be classified as program or support. Therefore, your expenses under your statement of activities is presented using your functional presentation. It is presented using your functional presentation. Take note of that. Okay? Some also classifies your support activities. They have your management, fundraising, and your membership development activities. But what I want you to learn here in your expenses, it must be classified by function. Function, what are the functions? Program, if ever it is in the furtherance of the purpose of the NPO. If not, it is considered a support activity or support expense. Okay? Where will your contributions or donations be presented? Under your revenue? And your contributions can either be presented as unrestricted, temporarily restricted, and permanently restricted. Next, statement of cash flows. Under your statement of cash flows is still the same. It's still the same concept. You need to show your cash flows from your operating, investing, and your financing. So you still need to present them either on the tree. Next, we have your notes to financial statement. Of course, your notes to financial statement presents your disclosures, particularly the changes as to your net assets. Changes as to your net assets. When we talk about your net asset, we have your unrestricted, temporarily restricted, and permanently restricted. Now, accounting for the fund of your NPOs, as I told you, the amount of the equity used by your NPO is given by your contributions or your donations. So we still use your fund accounting. So NPOs uses this method to account for contributions, grants, appropriations, and so on. This segregates the accounting records of resources restricted for specific purposes. That's why the reason why we account for three net assets. Those are your unrestricted, temporarily restricted, and your permanently restricted. Now we also have your fund theory. In your fund theory, it stresses great importance on the custody and administration of funds. You already know this one. This shows the management stewardship or the organization stewardship of those funds. The same concept that we have learned before under your government accounting. The classification of net assets of your NPOs. We said your NPOs can, and the net asset of your NPOs or the contributions on your NPOs can be accounted either as restricted or unrestricted. So when can we say it is restricted and when can we say it is unrestricted? It is restricted when it is with donor restrictions. It is unrestricted if it is without donor imposed restrictions. Take note of this. When we talk about restrictions, it must be donor imposed. If BOT or organization impose it, not considered. Okay? If it is the board of trustees or the organization who impose it, it is not considered. It is not considered as a restriction. It must always be donor imposed. Now, we don't have problem in your unrestricted because so long as there is no donor imposed restriction or without donor imposed restriction, then it is unrestricted. When can we say it is permanently restricted and temporarily restricted? So when we say permanently restricted, the restriction here is in perpetuity. When we say in perpetuity, until we don't know when, it does not expire. The restriction do not expire. While in your temporary, we have two types of restriction. It can be a time restriction or a purpose restriction. When we say time restriction, it is restricted through time. Eventually, the time will expire. Okay? The time will expire. So, through passage of time, ultimately, it will expire. Next, purpose restriction. This is restricted in fulfillment of a particular purpose. So what we look here is the purpose of the restriction itself, and it will expire if ever purpose is met. Purpose is met, it will expire. Okay, so again, how do we classify the net assets of your NPOs? It can either be restricted or unrestricted. When it is restricted, it is with donor restrictions. If it is unrestricted, it is without donor imposed restrictions. Now, when we talk about restricted, that can either be a permanent restriction or a temporary restriction. When we say permanent restriction, it is in perpetuity. When we say in perpetuity, it does not expire. It does not expire. But when it is a temporary restriction, it can either be a time restriction or purpose restriction. Why is it considered temporary? There is a restriction. There is a restriction, but ultimately, the restriction will expire. So examples or the types of temporary restriction is your time restriction. It is restricted through time. So once the time will expire, it is considered unrestricted. Purpose restriction, it is restricted in fulfillment of a particular purpose. So once purpose is met, it is considered the restriction is expired, it is unrestricted. Therefore, we know that temporary can become unrestricted. Temporary can become unrestricted. So this is known as reclassification of net assets. This is when the temporary restricted net asset will become unrestricted. Okay? So we reclassify net assets. Sir, when do we reclassify net assets? Only on one particular time. And that is when the temporary restricted net asset will become unrestricted. Sir, can the permanently restricted be considered unrestricted? No. Because, again, permanently restricted net assets do not expire. Since it does not expire, you cannot reclassify it. What can you reclassify only? Only temporary restricted net assets to unrestricted. So in your reclassification of net assets, NPOs reclassify resources from temporarily restricted net assets to unrestricted net assets. Why? We have already said two reasons a while back. The first reason is that the purpose is already met. And when can we say purpose is already met? First one, if the money was appropriately expended for an expense designated by the donor. So for example, the donor designated 50,000 pesos, which is donated particularly to help the victims of the flood last November, etc. So once that is already used, what happens? There is a release of restriction. We reclassify it from temporarily restricted to unrestricted. Another, if money was appropriately expended for an asset as designated by the donor, so another purpose. What is the purpose here? The purchase of an asset. So for example, the donor said, or the donation of 500,000 will be used to purchase a tract of land beside the not-for-profit organization office. So the 500,000 pesos, the purpose of that is to purchase a tract of land beside the not-for-profit organization office. So once you purchase that and you use the money already for that, then the purpose is already met. We reclassify the net asset from temporarily restricted to unrestricted. And last reason why we reclassify your net asset from temporarily restricted to unrestricted is that the time already expired. Okay? The time already expired. So a donor restriction based on time was satisfied. So for example, I will give you 500,000, but you should not use it for 5 years. So once it is already 5 years and 1 day, then the restriction is already met. Then it is already considered unrestricted. Okay, take note. When can we only reclassify net assets? When the temporarily restricted net asset will become unrestricted. We keep on talking about your net assets. And we said your net assets come from your contributions. Your contributions can be a contribution per se or a promise to give. So what is the difference on these types of contributions? So the first one, we have your contributions per se. A contribution per se is an unconditional transfer of cash or other assets to an entity, or a settlement or cancellation of its liability in a voluntary non-reciprocal transfer by another entity acting other than as the owner. So that is a contribution. Contribution, whether restricted or unrestricted, is measured at fair value. So whether it is restricted or unrestricted, you measure it at fair value and you account for it as revenue. You account for it as a revenue when they are already received. Now, how about a promise to give? So these are mere promises. So when we say mere promises, these are written or oral agreement to contribute cash or other assets to another entity. Sometimes this is known as pledges. They can be considered conditional or unconditional. So how do we account for a conditional promise to give and an unconditional promise to give? A conditional promise to give is not recognized. An unconditional promise to give is recognized. It is considered, it is recognized, it is considered as a revenue and a receivable. It is considered as a revenue and a receivable. But how do we measure it? This one is not measured. Sir, why do we not measure a conditional? Because it is not recognized. While unconditional is measured at fair value. When we say fair value, it is at the net realizable value, meaning net of any possible doubtful account, net of doubtful accounts, and it is measured at present value. Therefore, the amount less any discount, then we measure that particular promise to give once it is unconditional at present value. Again. So your promise to give or your pledges is an oral agreement. However, an oral agreement can be recognized or not, depending on the type of the pledge or promise to give. If the pledge or promise to give is conditional, it is not recognized. But if the pledge or promise to give is unconditional, it is recognized. Now, how do we measure it? A conditional promise to give or a conditional pledge is not measured, while an unconditional promise to give or an unconditional pledge must be measured at fair value. So when we talk about fair value, it is at NRV or net of any doubtful account, or at present value, that is a with reduction of a discount. So again, contributions, meaning you have already received it. Once you have already received it, it is always considered as a revenue. But if that is a mere promise to give or a pledge, you look whether the pledge is conditional or unconditional. So let's have an example as to your contributions. So UC received the following pledges. Okay, take note. If the pledge is considered conditional, not recognized. If the pledge is considered unconditional, it is recognized. When we say conditional, there is a condition. So let's look at it. So the first one, UC receive 100,000 pledge to be paid in at 8 months that is restricted for the purchase of library books. So it will be restricted for the purchase of library books. This restriction is a donor-imposed restriction, not a condition. So question, is the first one conditional or unconditional? The first one is considered unconditional. Second one, 900,000 pledge to be made in if a famous biology professor if is hard, if a famous biology professor is hard, this is considered a condition. Therefore, it is not recognized. So, how much or what amount of pledge is recognized? Only the 100,000. Take note, you recognize only when it is unconditional. Next example, UC reported gross contributions receivable of 175.8 million. The balance being reported was reduced by the present value of expected cash flows of 6.3 and allowance for doubtful accounts of 38.4 million. How much is the reported net contribution receivable? So we said we measure this one at fair value, right? And when we talk about fair value, this is decreased by changes in the present value and decreased by the NRV of your receivable. Therefore, if the receivable is 175.8 million, it will be decreased by the present value or the discount of 6.3 million, further decreased by the allowance for doubtful accounts of 38.4 million. So how much is our net contribution receivable? So 175.8 less 6.3 less 38.4 will give us 131.1 million. 131.1 million. So that's how we account for your contributions. So again, when we talk about your contributions, this is already considered as a revenue or a receivable. And then if that is a promise to give or a pledge, how do we account for it? It depends whether it is conditional or unconditional. If it is conditional, then it is not recognized. If it is unconditional, it is recognized. And how do we measure both? At fair value, which is decreased by the changes in the present value, if ever it will be collected in the future, and any amount which reduces the NRV of the receivable or the realizable value of the receivable. Another example, due to the rising COVID-19 cases, Red Cross instituted a campaign this 2020 and distributed masks and alcohols to all residents in the community. The distribution cost is 14.5 million. As a result of the campaign, it received unrestricted cash contributions of 400 million, unconditional promises to give of 60 million. Of this 60 million, 20 million is not collectible until 2021. Red Cross estimated that 10% of the pledges will be uncollectible. Okay, so we have here your contributions per se, which is 400 million. And then we have your pledges, which is 60 million. In the 60 million, 40 million is unconditional, and the 20 million is collectible until 2021. So this is more of your conditional restriction, or it's not conditional restriction, by the way. It is known as your temporarily restricted unconditional pledge. Okay. And then 10% of the pledge will be uncollectible. So less 10%. So less 4 million. This is 36 million. Less 10%. This is 2 million. This will give us 18 million. Now, it asks you about unrestricted. Contributions are always unrestricted here because it is considered unrestricted. Here, the 36 million as unconditional pledge is also unrestricted, while the 18 million is temporarily restricted. So how much is the unrestricted? 400 million plus 36 million will give us 436 million. And the temporarily restricted, we have 18 million. But if the question is the total receivable, everything will be included. That is 400 plus 36 plus 18. This will give us 454 million. In case, guys, that if the question is total receivable, then we can account both for the contributions and your pledges. But if the question is unrestricted, you need to classify the pledge because one is unrestricted, the other is temporarily restricted through the time, which you will receive only up to 2021. Therefore, you should properly account for it, whether it is unrestricted, temporarily restricted, or permanently restricted. However, whatever is the concept we have learned a while back in your contributions will still apply. Now, this is just a mixture of both contributions and the classification of the net asset. Now, let's discuss collection. So what is a collection? A collection are works of art, historical treasures, and similar items. Why are they considered collections? Because they are collected primarily to be displayed. So you collect art, you collect treasures, you collect other items that can be presented as part of your collections. Now, your collections are held for public exhibition, education, or research. They are protected, kept, encumbered, cared for, and preserved, and they are subject to an organizational policy. So, what is the effect of your collections, therefore? When we talk about collections, when you receive the art, when you receive the historical treasures, and when you receive the similar items, they are not capitalized. They are not capitalized. Therefore, they are not recorded in any net asset. They are not recorded in any net asset. Sir, when can we account for it as part of our net asset? You can only account for it as part of your net asset when it is sold. Okay? When it is sold, you account for it. Again, when you receive the collection, it is not capitalized. But when it is sold, you account for it as an increase in net asset. Now, let's go to your categories of not-for-profit organizations. So first, VHWO, or Voluntary Health and Welfare Organizations. These NPOs are supported by and provide voluntary services to the public, normally uses their resources to solve basic social problems in the area of health or welfare, either globally, nationally, at the community level, or on an individual basis. So a while back, we already discussed what is the VHWO during our introduction. Now, healthcare organization. So what are healthcare organizations? We said a while back, these are normally hospitals. But your healthcare organization include also clinics, ambulatory care organizations, continuing care retirement communities, health maintenance organizations, home health agencies, hospitals, healthcare entities, nursing homes that provide healthcare. So anything or any not-for-profit organization primarily for healthcare can be considered healthcare organization. But what do you think is unique in an health or in a healthcare organization? So what is unique in a healthcare organization? The unique is the of revenue. Source of revenue. So a while back, what we know is normally we have your contributions as source of revenue. Contributions as source of revenue. However, in a healthcare organization, aside from your contributions, there are other revenue sources. And what are those revenue sources? So first, we have your premium fees. Premium fees are known as your subscriber fees or your capitation fees. They are revenues from agreements under which a hospital provides a necessary patient services for a specific fee. Uh, outpatient services, some outpatient services, they have premium fees. So if that is a non-stock, non-profit hospital, and there is a premium fee that is part of its revenue source. Another is your other operating revenue. These are revenue from services to patients other than healthcare and revenue from sales and services provided to non-patients. So when we say other than healthcare, for example, we have your charges for the preparation of medical records, the rental of the hospital space, what else? The cafeteria, the snack, those are cafeteria, snack, the fees for medical records, these are other non-operating revenues or other operating revenues. So when we say non-operating revenues, it is not connected. It is not connected. So these are revenues not directly related to an entity's principal uh, principal operations. So here we have three: premium fees, other operating revenues, and non-operating revenues. And aside from that, we have the main revenue source of a healthcare organization, that is your patient service revenue. So what is a patient service revenue? A patient service revenue include room and board, nursing services, and other professional services. However, it is reduced by courtesy allowances. These are discounts for doctors and employees. And then we have your contractual adjustments. These are discounts arranged with third-party payers, which are your Medicare, PhilHealth, etc., that frequently have agreements to reimburse at less than an established rates. So the gross patient service revenue is deducted by your contractual adjustment and your courtesy allowance. We have your net patient service revenue. Your net patient service revenue, this is your accounts receivable. And to get for your net realizable value of accounts receivable, you deduct the doubtful accounts. Okay, again, um, normal NPOs will only have income or revenue source from the contributions. However, healthcare organization has four sources. The first source that we talked about a while back is your premium fees. Another source is your other operating revenue. Then we have your non-operating revenue. And then lastly, we have your patient service revenue, wherein the patient service revenue is reduced by contractual adjustment and your courtesy allowance. Okay, that's how we compute for your revenue sources for healthcare organization. So let's have an example. So healthcare organization example for revenue sources. So Baguio General Hospital is a non-governmental, not-for-profit hospital. The following transactions relates to the revenues and contributions received during year 2020. So gross charges at established rates for services rendered to patients amounted to 1.3 million. So that is your gross patient revenue, 1.3 million. The hospital had contractual adjustments with PhilHealth of 300,000. So contractual adjustment, you deduct that, 300,000. Hospital staff and their dependents receive courtesy discounts. So we have courtesy allowances of 9,000. This will give us your net patient revenue. So this net patient revenue is computed at 991,000. Then we have your Baguio General Hospital receives premium revenue from capitation agreements totaling 454,000. So that is your premium fees, 454,000. Throughout the year, the hospital offers several healthcare courses for which it charges tuition. Revenue for hospital space rental is 72. Tuition is 24,000. So these are your other operating revenue. So we have here your rental, 72,000. Course, 24,000. Furthermore, received from gift shop of 85,000 and cafeteria of 135,000. How do we classify again your cafeteria and your gift shop? They are considered other operating revenue also. So gift shop, 85,000. And then cafeteria, 135,000. So how much is your other operating revenue? So we have 72 plus 24,000 plus 85 plus 135. We have here 316,000 pesos. 316,000 pesos. So if the question is, how much is the amount of our gross patient revenue? Your gross patient service revenue is 1.3. How about the net patient service revenue? 991,000. How about your patient's accounts receivable? Answer, 991,000. Patient AR is still 991,000. But if the question is the NRV of your AR, if that is NRV of AR, you also deduct bad debts. Okay? You deduct bad debts of 2%. Okay? So if ever the question is NRV of AR, then you can now deduct the 2% bad debts. Premium fees, your answer is 454. Other operating revenue, we have here the 72,000, the 24,000, 85,000, and 135,000, totaling 316,000 pesos. So that's it for healthcare organization. How about colleges and universities? In your colleges and universities, they provide educational services. Now, again, as a general rule, the revenue comes only from your contributions or your donations or your grants. However, there are other sources of revenue for colleges and universities. And what are these other sources of revenue? So the following are the other sources of revenue for colleges and university. So first, tuitions and fees. So these are the amount of tuition that is taken or that is collected from the students. So private colleges and universities recognize the full amount of tuitions and fees, net of refunds, assessed against students for educational purposes. Tuition waivers for scholarships are contra revenue account. Bad debts are support expense. Another revenue sources is the subsidy. It is treated as an unrestricted revenue. It is like your contribution. And then we have your third-party student aid. They are not considered as revenue, but a liability. So therefore, in computing for your revenue here, we have your tuition, less your tuition waiver. This is your net revenue. Okay? Tuition, less tuition waiver, that is your net revenue. How about your third-party student aid? Sir, what is a third-party student aid? That is a scholarship provided to the students, but the scholarship is not given by the entity itself. So the scholarship is given by outside entities. So, for example, a private organization now giving a scholarship for the students of, let's say, NTC. So, those are considered third-party student aid. Just take note, if that is a third-party student aid, that is considered as a liability. So let's have an example. So student tuition and fees for University of the Cordillera total 1 million. Student tuition fees also include 50,000 of tuition reductions provided under a fellowship program that requires no services on the part of the student. They are also granted an outside scholarship of 30,000, and the bad debts is 3% of gross revenue. So the question is unrestricted revenue. So since the question is unrestricted revenue, then we need to remove the total amount of our, we get only the unrestricted revenue. That is not the net amount of our revenue. Okay, so our unrestricted revenue therefore is 1 million still. How about if the question is net revenue? Your net revenue is 1 million less 50,000. We have 950,000. Sir, how about 30,000 pesos? The 30,000 pesos is considered as a liability. Why? Because this is from a outside scholarship. And how do we treat a outside scholarship? Outside scholarship is treated as a third party student financial aid or third party aid, and a third party aid is always treated as a liability. And that's it for your NPOs.